Welcome. Look, you get it in today's financial world, things move fast. Getting the essential knowledge quickly is absolutely key.
And right now, the silver market, well, it's flashing all sorts of warnings, things we haven't seen in decades, really.
Yeah, exactly. We're looking at insights from Mike Maloney's latest analysis today. He argues pretty strongly that the market's in, quote, absolute turmoil and actually breaking right before our eyes.
So our job today really is to unpack the evidence, to see if that paper system, the one setting silver prices for years,
The COMEX, the LBMA.
right, if it's cracking. And
Yeah.
crucially, what this lack of liquidity means for you, for anyone holding assets, whether it's paper or physical.
Yeah.
Because a major repricing could be on the cards.
Definitely. Okay, before we dive into the mechanics of all this, if this kind of focused analysis helps you, connect the dots in this macro environment,
Which we hope it does.
yeah, please make sure you subscribe to Crear Divia. It really helps us keep this going.
Okay, so where do we start? The signals. Let's get straight to the numbers. The ones that signal something is just profoundly wrong. And we have to start with the, frankly, shocking data point. Silver lease rates, right? Lease rates. For anyone maybe not familiar, it's basically the interest rate you pay to borrow physical silver. Think of it like, I don't know, interest on a loan.
Okay, simple enough.
And in a normal, healthy market, these rates, they're usually tiny, like around 0%, sometimes even -1%, meaning people pay you to take their silver off their hands just to cover storage costs.
Okay, so near zero is normal. What were they just say a week ago? Still pretty high then, weren't they?
Yeah, already elevated, maybe 9 to 12% range, which that itself was unusual.
And now,
Now they've absolutely exploded, over 33.5%.
33.5%. That's not a market move. That's a market breaking, isn't it?
It's orders of magnitude beyond anything you'd expect. A rate like that is basically the market screaming, there is no physical metal. We can't find any to lend.
Wow. And what's the immediate fallout from that? Who gets hit first?
Well, it has a huge immediate consequence for one group in particular, the short sellers, the big players who bet against silver.
Ah, right. The source material calls this a death spiral for them. Can you maybe walk us through why it's so bad for the shorts?
Absolutely. So these sellers, they borrowed physical silver earlier. They sold it immediately, thinking, the price will fall, I'll buy it back cheaper, return the metal and pocket the difference. Standard short selling.
Okay.
But now they're caught badly. They're bleeding in two ways. First, the price of silver is rising, not falling. So their bet is losing money on paper.
Right, that's the obvious loss.
But second, and this is the killer, they have to pay that 33% interest annually on the physical silver they borrowed and still owe back.
Ouch. So the rising price hurts, and they're paying this massive interest cost just to maintain the losing position. It's a double whammy.
Exactly. It compounds daily. Their only way out
Yeah.
to stop the bleeding.
They have to buy silver.
They have to buy physical silver, go into the open market, find actual ounces, not paper contracts, and return them to the lender. This forced buying creates huge new demand for physical metal.
At the exact moment the market is screaming there isn't any?
Precisely. It turns what might have been just a financial squeeze into a potentially catastrophic physical squeeze.
So they're scrambling for ounces. But where do these ounces even come from? Which brings us, I guess, to the physical side of things globally. The squeeze is showing up in some really concerning ways, especially in the East.
Yeah, look at India. Huge silver importer, culturally very important there. And right now, reports say dealers are just sold out, completely dry.
Buyers are offering big premiums over the spot price, I read, but still no metal available.
That's the situation. Premiums are high, but there's simply no supply. And it's not just small shops feeling this.
No.
No. One of India's largest asset managers, UTI Asset Management, actually had to suspend new investments into its silver ETF.
Wait, suspend new money into their silver ETF? That's a massive red flag, surely.
It's huge. Think about what that means. A major financial institution is basically saying, sell orders only. Not because a regulator told them to, but because they physically cannot find the silver required to back the new ETF shares people want to buy.
Wow. That inability to deliver, doesn't that echo history? Like 1980, the Hunt brothers situation.
It's disturbingly similar. Back then, the exchanges effectively changed the rules to liquidation only to break the hunts and cap the price. The paper contract essentially failed to deliver the physical. Here, the market is failing to deliver, forcing the fund's hand.
So the demand pressure is intense, especially from the East. But there's another piece, right? A bottleneck stopping the West from maybe filling that gap. The The refineries.
Exactly, the refinery choke point. This is critical because if you look at the West, you see something different happening.
What's that?
You have investors, maybe smaller holders, seeing the silver price at, say, $51 an ounce on the screen. Nominally, that looks like a multi-year high. So they think, great time to sell. They start digging out old jewelry, sterling silverware, scrap silver.
Stuff that isn't pure .999 fine bars, right?
Exactly. It's lower grade stuff.
Yeah.
And it can't just be traded on the COMEX immediately. It has to be melted down, refined, purified up to 99.9% fine silver.
And that's where the problem is.
That's the choke point. The refineries, particularly in the U.S., are reportedly completely jammed. They have backlogs stretching out for months.
A month. So even if people are selling scrap.
It can't get into the system quickly. Dealers are apparently offering only maybe 50% of the spot price for this lower grade silver. Why? Because they know they can't get it refined anytime soon. There's just no capacity.
We saw something like this back in 1982, didn't we? The big melt, where our refining capacity just seized up for half a year.
It's a historical parallel. It means even if there is a wave of Western selling of old silver, trying to maybe push the price down or arbitrage the gap, it gets stuck. It physically cannot enter the deliverable market fast enough to matter in the short term. It's trapped in the queue.
So this structural block just makes the liquidity crisis even worse, regardless of people selling their grandma's silverware.
It guarantees a fiscal tightness persists for now.
Okay, this is pretty complex, but also makes a scary amount of sense. If this synthesis, connecting the financial signals to the real-world physical constraints, is helping you understand the big picture.
And how fragile things might be.
Yeah, please do consider subscribing to Kiervia. It's genuinely how we manage to keep bringing you this kind of distilled knowledge.
All right, so we have this physical tightness, this refinery jam.
Yeah.
What's happening between the major trading hubs, the East and West?
Well, this scarcity has created, frankly, a bizarre situation, a massive arbitrage opportunity, because the price gap between the paper exchanges like COMEX and the physical markets, especially in Asia, is just staggering.
Yeah, the numbers are pretty wild. We're seeing physical silver in Shanghai trading around, what, $59 an ounce?
Roughly, yeah, $59. Meanwhile, COMEX in New York is lagging way behind, sitting around $51.
59 versus 51, that's an $8 difference per ounce.
An $8 gap in commodities. Isn't that
Yeah.
huge? Don't these things normally get arbitraged away almost instantly by the big banks? Buy low on COMEX, sell high in Shanghai.
That's exactly the question that shows the system is broken.
Yeah.
Normally, yes, that gap would vanish in minutes. But why isn't it now?
Why?
Because of everything we just discussed.
Yeah.
Illiquidity. Execution risk. You can't just click buy on COMEX paper and guarantee you'll get prompt delivery of physical bars you can then ship.
So taking delivery itself is the problem.
It's a major hurdle.
Yeah.
Arbitraging this gap now means actually sourcing the physical bars, booking cargo flights, dealing with all the logistics, the refiner delays we mentioned, maybe even political risk. It's messy and expensive.
So that $8 premium, it's essentially the market price for all that hassle and risk.
Pretty much. And what's the result? Traders are doing it, despite the difficulty. They're physically moving bars, loading them onto planes, flying them from west to east to London to China to capture those premiums.
It's a physical drain. Silver is literally flowing out of Western vaults towards the east, pulled by this price gap that the paper markets aren't closing.
Which brings us back to the sellers in the West, the ones liquidating their sterling silver at $51. There's a huge misconception there.
They think they're selling high.
They think 51 is a great price, but adjust for inflation. It's actually incredibly cheap.
Okay, let's put some numbers on that. The 1980 peak was around $50 an ounce back then. What's that in today's money? It depends on the inflation index you use, obviously.
Conservatively, you're looking at somewhere between, say, $180 and $200 an ounce in today's dollars, maybe even more.
So compared to the inflation-adjusted high of maybe $200, today's $51 is.
It's not just cheap, it's dramatically suppressed. People selling now might think they're locking in a profit, but they could be selling near a generational low in real terms. The metal would need to basically quadruple just to reach its previous inflation-adjusted peak.
They're selling into what could be a massive buying opportunity created because the paper market seems broken.
And you see the backdrop, right? It fits. Gold has quietly surged past, what, $4,100 an ounce?
Driven by relentless central bank buying, especially non-Western ones.
Exactly. That signals a massive institutional move away from fiat currency risk, primarily the dollar. The paper silver market looks like it's just the last piece to catch up, and it's failing to price the physical reality. That $8 Shanghai premium, that's proof the physical market is now dictating terms.
So the core warning here seems unavoidable. The plumbing, the financial infrastructure of the silver market, it's compromised.
Deeply compromised. Physical liquidity, gone. Supply chain, collapsed in key areas. And the East is just hoovering up Western inventories. The paper system is cracking under the strain of physical reality. So for you, listening to this, the advice coming out of this analysis is pretty direct. Prioritize owning physical metal. And specifically, 0.999 fine bars or recognizable government coins. Things that don't need re-refining and won't get stuck in that refinery queue we talked about.
Yeah, crucially, the guidance is to avoid relying too heavily on paper promises.
Oh.
Things like ETFs, SLV, GLD, or other custodial accounts.
Because as we saw with that Indian fund, when the physical metal isn't there, those paper claims, they could be frozen, limited, maybe even revalued without your say-so.
Right now, where your asset is held seems almost as important as what asset you hold. Location matters.
And this whole situation, this level of crisis, it makes some mainstream forecasts look well.
A little out of touch. Bank of America, for example, they see $65 silver, right? But not until 2026.
Yeah, 2026. Based on the lease rates, the physical drain we're seeing now, that forecast feels, as the source material put it, so far behind the curve. This kind of repricing could happen much, much faster, maybe almost overnight if something snaps.
And ultimately, what we're seeing is silver kind of reasserting its historical role, isn't it, as a store of value.
Globally. The data apparently shows silver's price taking off against like over 55 different fiat currencies around the world, which really just highlights how those currencies are falling against silver.
So the final thought, the provocative question for you to consider based on all this.
Yeah, given this unprecedented physical squeeze, this disconnect,
Yeah.
can the big Western exchanges, the COMEX and the LBMA, actually survive this?
Mm-hmm.
Can they maintain control over pricing when the physical reality is so detached?
Or is this it? Is this the moment the ease driven by physical demand effectively takes over the global pricing of silver and maybe gold too? Something to really think about as this unfolds.
It's happening in real time.
Absolutely. If this conversation helped to clarify that big picture for you, helped you connect some of these critical pieces, please make sure you're subscribed to CREDVOU. That way you won't miss any vital updates as these markets continue to evolve.